U.S. stock averages have been enjoying a stellar performance this year. In the previous session, we saw the major indexes tumble, but today we're seeing a partial recovery. So there's no better time than now to speak to Stephen Guilfoyle of Sarge 986. Sarge, great to have you here today.
Thank you for having me, Remy. There is no better time.
Well, yesterday we did get that bloodbath in the equity market, so we had been seeing very low volatility prior to yesterday's session and little reaction to geopolitics as well as politics. So do you think what's happening in Washington, D.C. and the Trump administration will be affecting equity markets going forward?
Well, I think there's no doubt. As we move forward, I think we're going to have to live with volatility. We're certainly entering, if we weren't already there, we're entering an era of headline risk. The president may be squeaky clean, it may not be an issue with his administration, but there's going to be a doubt. And until this former FBI director Mueller comes to any conclusions, well, every little leaked headline is going to move markets around. And as we saw yesterday, the market took one right in the face. And it was nasty. I mean, by the late afternoon, so many guys or gals had such negative P&Ls that it really kind of snuck up on them, because many people in the morning expected people to buy the dip, and it just didn't materialize. So this is a condition we're going to have to live with, and the VIX will probably be elevated going forward.
And now that we've covered that, I do want to move on over to the U.S. economy. Now, we got our first Fed speech of the week from Loretta Mester today, and we did get the same hawkish comment expected. But going forward, there are some concerns about whether or not we'll be getting Fed rate hikes given the slowdown in some of the economic data releases. So what do you expect to see in terms of rate hikes as well as Fed action?
Well, Loretta Mester is a hawk, and pretty much the whole FOMC is pretty hawkish right now. Even with the contraction in probabilities that we've seen on the CME, they're still pricing in close to a 2 and 3 chance of a rate hike in June. And to be honest, although some of the data has been mushy, industrial production was surprisingly strong. The Atlanta Fed's pricing in a GDP of still over 4% for the quarter, annualized. So I don't see an impetus for the FOMC not to go ahead with a rate hike that they would like to go ahead with. I think it might be foolhardy, but that's not my decision. And they seem heck bent on the trajectory of where they want to go with policy. The marketplace is not supposed to impact their thinking, so I think if things remain the same. Now, if there's a calamity from the political universe or geopolitical universe, that could change things. But if things remain the same, I do think that you'll see a rate hike next month.
Well, if we look at Fed funds futures, we are seeing a weakening in the percentage, but we still have some ways to go before the next meeting, so we'll see what happens. But I do want to get your take on earnings. We got earnings out from retailers including Wal-Mart as well as Target. Now, we know what's happening in terms of brick and mortar retail stores. So what did you make of the latest results?
Well, quite fascinating, actually. They both reacted well, Target and Walmart. I'm long Walmart, just to put that out there. Walmart though displayed a 1.4% year-over-year increase in revenue. Target actually saw a contraction in revenue. I'm a big fan of Walmart as they go forward, tackling Amazon in some pretty technological ways. Not just the earnings that we've seen, but they have the store number 8, which is really a venture capitalist type incubator for highly technical type businesses. There's a couple of projects now coming out of that. They have Walmart Labs in San Francisco. This firm really is trying to evolve, and it's been reflected in the stock price. I measured the stock this morning is up something like 9.2% year to date. It's probably up 10% now with today's move. And versus retail, versus the whole market, that's pretty good. But versus retail, that's outstanding. And
we all have smart devices, and we can comparison shop anytime we feel like it. So I think stores do have a challenge to conquer going forward. But last but not least, before I wrap it up, we do have the OPEC meeting taking place on May 25th in Vienna, Austria. Now, we saw the volatility in oil prices last week based on expectations of further OPEC output cuts. But where do you see oil going as we head into the driving season?
I think $49.50-ish, $49.50, not $49.50, $49.50, we'll say, is something of a gateway to a higher price for WTI crude. There may be a knee jerk above that level next the 25th, whatever the 25th is. I think it's about a week away when OPEC holds their meeting, and when non-OPEC firms like Russia join in and probably extend this production cut for up to another 9 months. I think that will be taken very well by the marketplace. Whether it can hold that level after it takes it will remain to be seen, because there still is a supply glut.
Before I let you go, I do want to ask about technical levels. What are you watching right now?
Well, let me look over my shoulder and see where we are. We're at 2372 right now in the S&P 500. 2368 was a level of resistance coming in today. So it's really important that after yesterday's bloodletting, we actually got to bounce above that level. I'd like to see us hold that level going forward. Next level is around 2377 if we can do that.
Okay, Sarge, well, great having you here at the New York Stock Exchange, and as always, thanks for insight and analysis.
Thank you for having me.